Hi, everyone. This is Jason Bierk of Wall Street from E Street. Welcome back to another Wall Street from E Street podcast interview. Today's special guest is a first-time guest, but I've been watching his interviews on Kitco and Wealthion lately. He has over 40 years of experience in investment management. He's the author of 9 books, including Wall Street Lies. He's a chartered financial analyst and also a certified financial planner. He is the managing partner and founder at Oxbow Advisors. Ted Oakley, thank you for joining me.
Thank you, Jason.
So, Ted, we're doing this interview on Monday, March 20th, 2023. A lot has happened to the banks over the weekend, especially the regional banks and Credit Suisse. Seems like the roles are just changing with the bailouts, no bailouts, the size of the bailouts, the currency swaps every couple hours lately, getting a lot of misinformation from governments. I want to get your thoughts, though, on the rate hikes that the Fed has done the last 12 months. Do you think that the rate hikes at this pace over the last 12 months, are we finally starting to see all the pain that the Fed has caused with the rate hikes? Is that what's triggering this banking crisis? Do you expect a lot larger mark-to-market losses for banks and pension funds going forward?
Well, what I think, Jason, is that the pain really happened because it kept the rates too low too long. So everybody bought into that. And so that set us up for when they had to go too strong on the upside, which that's really an admission of guilt. They had so many big moves up. And then that threw everything in disarray. And I think people bought into it. That's how it came about.
Now, we had a little audio problem earlier, and you were explaining how you owned part of a bank and the mark-to-market losses for the bank. So could you just summarize that really quickly for our listeners out there who aren't familiar with what a bank has to do when they get depositor funds, and then what do they go in and buy US Treasuries then to cover some of that?
Well, what happens is banks have three categories of bonds. They have what we call tradable securities, which you have to mark to the market. You have to mark those. And then they have a group called available for sale that you couldn't, but you could sell them, but you don't have to mark to market unless you sell them. And then you have what we call hold to maturity. The problem about hold to maturity is if you hedge that takes away the ability it has to be marked to market automatically. So they're caught between a rock and a hard place. Most banks have primarily available for sale and a few held to maturity. But see, they don't have to mark those to the market unless their deposits fall to a point to where they have to really get some liquidity. And then they have to sell the bonds, and then they have to take the mark. See, and it goes against capital, it goes to the income statement at that point.
So is that basically what has been happening to Silicon Valley Bank and First Republic Bank, and why they needed depositor funds coming in with the $30 billion that the larger banks put in?
Well, I think, I don't know. I don't know SBB, but it looked like to me the thing they did wrong was they had not a bad idea really of cleaning up the bond desk, the bonds a little bit, but they should have raised the capital first and then sold the bonds. See, when they sold the bonds, they had to take the mark, and then they couldn't raise the $2.5 billion in capital, and so that blew the whole thing up. I'm not as familiar with First Republic, but it's in the same vein, where your deposits leave, you're lower, and then all of a sudden you've got to sell some bonds so your liquidity matches up because you have requirements with the Fed. And so that's the jam they're in. I don't see people leaving the bank deposits really at this point, though. I know some have for better rates, but I don't see them just really moving all deposits out of community banks. It doesn't seem like that's going to happen.
Do you think that Credit Suisse is the bigger problem at this point? Because the Fed over the weekend put in these currency swap lines. It seems a lot of it's to give these the G7 central banks extra US dollars.
Well, it is. If you look at what happened in Credit Suisse, this is one of the things that goes on. A lot of banks get what we call sub debt. So it's part of the tier one capital, but it's sub debt that they get from people, and then that may or may not be convertible in equity. Well, what happened in this was they wiped out all the sub debt because that's probably going to be hard in the future to get sub debt people to give it to banks. And then the second thing is, there just wasn't enough there. And I don't know if you remember, but it was a few years ago, and I can't give you the exact time. These two actually were thinking about getting together in the And the government said, no, no. And so now they bring them back together themselves. And so, it's just,
Well, now it's a
you know,
shotgun wedding. Since you're from Texas,
yeah,
it's a shotgun wedding now.
yeah, it is for sure.
Just like in 2008, how I very seriously doubt Jamie Dimon and JP Morgan wanted to buy Bear Stearns, and I very seriously doubt Bank of America wanted to buy Merrill Lynch.
Well, I don't think they did. I mean, I was obviously around then, and everybody thought after Bear Stearns went down that that's over. We got all the bad problems out of the way, kind of like now. And then, unfortunately, it just kept on coming. And so that's the way these bear markets go, though.
Do you think that pension funds are also looking at enormous problems with mark-to-market losses, and they're going to need bailouts too?
Jason, I think the number one problem with pension funds right now is that they've got too many alternatives and they don't know what they're worth. They have a consultant telling them what they're worth, but I promise you, if they went to have to get out, get liquid, they don't have a clue. And they have too much. A lot of them have 30, 35% in alternatives, hedge funds, private equity, private real estate, everything. They don't have a clue. And they got way far out in that area because they were trying to get yield to stay up with the numbers they needed. And that, if I were estimating, that's the number one problem with pension funds today.
Yeah, they also have a lot of commercial real estate exposure. So do these real estate investment trusts. We're just seeing across the board lately, Ted, the last month or two, enormous dividend cuts. So do you think that commercial real estate is going to be one of the largest pain points?
Actually, interesting you say that, Jason. I think that'll be the next problem for commercial banks will be what we call CRE, commercial real estate, because they're not ready for it. You have the highest percentage of CRE, commercial real estate, in the banks today than we've ever had. I mean, it's high. It's probably 68, 70%. And the problem with that is this. That's a big piece of their assets. And so when it gets in trouble, which is always the last thing to get in trouble. See, real estate is the last thing, but it's one of the worst things. And when that comes around, I don't think they're set up to deal with it because I don't really think they believe it right now.
Are there any specific industries where you think there's going to be a lot of dividend cuts? So it looks like real estate investment trusts are the main one right now, where if you own a lot of these shares and you're relying on income, you're going to take a big hit soon if you haven't already. Are there any other industries you think maybe besides real estate investment trusts that have commercial real estate exposure?
Well, obviously, we don't own these now, but we have owned a lot of oil and gas royalty companies and we own the majors. We sold most of those last October, November, but obviously because the price of oil, they may not cut them, but it's going to be really tight, and the royalty companies will have to cut. They're going to have to cut that sort of stuff. You're going to probably see that, and in addition, you're going to see probably a lot of, and I don't own these names or anything like that, but in the consumer type stocks where a consumer company has a lot of debt, it's a consumer product, and the consumers say, hey, I got to cut back. Those are going to feel that effect as well. So there'll be a number of them, I think, that will get beaten up by all of that when it's all said and done.
And I remember seeing your interview on Wealthy on talking about the oil royalty stocks. And I also, my day job was a oil and gas stock analyst. There's been a lot of mergers and acquisitions in the oil and natural gas royalty space, but those companies don't free cash flow like the Franco-Nevadas do with gold and silver precious metal royalties. So they only make free cash flow when there's a lot of drilling and at higher oil and natural gas prices, right?
Well, that's true. They do get some, but the problem is the reason we sold out of them is because one of the main ones we own, which didn't have any debt, a smaller one got bought out by a large one that had a lot more debt. We owned Texas Pacific a number of years ago, and probably sold it 10 or 15% too soon. But we don't own any of those now. We're out because we just think oil goes down in a recession, and it's hard for oil and gas people to accept that, but it does.
I mean, eventually, though, it's going to have to go back up because of, I think, the drilling costs for Schlumberger and the oil service companies, they're raising prices. So we're looking at a train wreck for energy prices where the costs are going up, the cost of production is going up, and the price itself to sell oil, natural gas, these things are going down. It looks like a train wreck.
It does in one respect, and I've been through a lot of breaks in the oil and gas business because I'm right here in the middle of it. And I've invested in oil and gas myself. But problem is that these service companies will hang in there and keep pushing that until they realize that, hey, we don't have any business. And then all of a sudden say they'll start to cut some pricing. But right now, the problem you've got is that, the price is coming down. We were, I think, 66, 67 today. And, it could go to 50. I mean, I don't know where it's headed, but it's not going to be up in a recession. I'll put it that way.
Are you still long-term bullish commodities because of supply side problems and as an inflation hedge, or are you less bullish commodities than you've spoken about publicly in the last 6 to 8 months?
Well, we always owned oil and we always owned the royalty companies. I'll tell you what we still own. We own the pipelines because they don't get affected so much by price. They just get paid on throughput. And we never were big in just natural gas companies because gas really moves around a lot. I think commodities will come and go over the next 10 years, like they more so than they have the last 10. And it wouldn't surprise me to have an upward bias because as resources go, generally most of our resources are declining. So probably, I'm guessing, you'll have more and more bouts of where the prices move up. I think you'll have to time it right, but I could see that happening.
Now, gold prices have had a nice rally the last couple weeks. Do you think that a gold bull market is restarting?
Well, we consider gold more of a currency than a lot of people do. So when times get crazy, particularly in weaker times, real rates are up, gold does better. We own gold in 2 of our 3 strategies, but I think it could do better. I think it could do better. We haven't really added or subtracted. We've kept the same percentage in it, but we like it. I think gold acts pretty good here.
I know you like the gold royalty companies because I've heard you talk at length publicly about them on Wealthion and elsewhere. The profit margins for those companies are really good because they don't have to worry about higher labor costs, higher diesel prices, higher electricity. They don't have to worry about those things nearly as much as the regular miners do.
That's true. I mean, we like Franco. We go way back with Pierre Lassant. He was just a great CEO, and if you think about it, there's no implications of having to make capital. Anytime you don't have to make capital expenditures, it's a better business. And so that's the way we sort of look at that. And believe it or not, Franco and those other miners, their dividends now are better than the S&P.
Well, it makes sense. They have better profit margins, right? Their profit margins are over $1,000 an ounce.
Yeah, that's true. So that's exactly right.
Well, a lot of people say, like, I hate gold stocks, but if you go back and look at Max charts post 2008, 2009, I mean, the charts for Franco-Nevada, Wheaton Precious Metals, Royal Gold, they're excellent compared to other regular gold mining stocks or many other stocks too.
If you look at the peak in gold in 2011 and the period it went through all the way up through 2016 or so, Franco kind of held their own during that period. They didn't suffer like a lot of the miners did. And so that's a reason. That's another reason we like Franco. I think in the long run, you'll always make money in Franco-Nevada.
Oh, yeah, I agree. The business is really good from a contrarian and counter-cyclical perspective because they had good profit margins, lower cost of capital, free cash flow. So during that bear market post 2011, like you said, the 5 or 6 years of the bear market in gold and silver, they were investing. So they were doing deals because they had cash when the miners were desperate for cash and the banks wouldn't give them any.
Yeah, and the problem today is it's so expensive to develop a new mine. That royalties are just a much better way to go than doing all of that capital expenditure.
So you've been around for over 40 years. Excuse me. So you've been around for over 40 years helping people in investment management, high net worth clients. Is this one of the most difficult environments in terms of government and central bank policy, asset price inflation, high interest rates? Do you think that this is the most difficult environment of your entire career?
No, I'll tell you why, Jason. I think in my career, there's been two, and I've been around since the late 70s, but there's been 2 super bubbles. Not. There's been other bear markets, but if you look at 1929, 1972, year 2000, and then now 2021, those were super bubbles. Okay, that's where everything went, and this one is bigger than 2000. And so everybody says I didn't see it coming, but really all they had to do was look around. Things were goofy, stupid, expensive, everything. And so it's just a matter of time before they break it. So it's not any harder for us, really. We play it about the same way we did 2000, which is very high liquidity, and just hold your liquidity through the bear, and you'll get a chance to put some of it to work, eventually at a really good price. And I think that's where we are now.
So by liquidity, do you mean cash like US dollars, maybe some short-term US treasuries and physical gold? Are those the types
No, we have about 4% gold in two of the three strategies, but no, I mean treasuries. We probably have 60 to 65% liquid, but it's mostly in US treasuries, and a lot of it's in what we call the variable rate treasury. It's a floating rate. It's been real good to us the last couple of years because it moved up. The rates moved up with the market. No, we don't keep it just in money. We don't like to keep that much in money markets of these firms because you don't know what's in those money markets. So we do mostly treasuries.
The money markets were loaning into repo. I mean, that got in trouble in 2019, and those money market funds had to get bailed out. A lot of people aren't aware of that.
No, and they never go in. I always ask them, somebody will say, hey, have you looked at, this firm or that firm or whatever, the money market's paying XYZ? I said, yeah, we'll look at it. But what you need to look at is the portfolio. What do they own? I had somebody call me about a JP Morgan fund. I looked at it and it was 41% foreign. Well, if they want to own that, that's fine. I just soon own the treasury, though.
Well, that sounds less risk than what was going on with some of the money market funds prior to the repo crisis back in 2019. There were some of them that were heavily loaning into repo, and then they couldn't get paid back.
Yeah. Yeah. I mean, you have to be careful with Wall Street. They'll sell anything.
What a lot of people aren't aware of this. I mean, they were still selling mortgage-backed securities, commercial real estate mortgage-backed securities, this stuff that's worse than junk bonds, the collateralized loan obligations. I mean, they were still selling this stuff only a few months ago. They're still making more of it. I don't know if the Fed's going to end up buying it, or pension funds, or who would, in the right mind, would buy it.
Well, and I think a lot of their private equity and private real estate funds, I don't think they have a clue what's in it. That's just me. But when you get down to real value, I'm not certain. They're so big, they don't really know what they have. And we're seeing, they make offers to us all the time on individual real estate pieces. I love real estate, but it's too expensive now. But we see these offerings now that are 25% lower than they were 3 or 4 years ago where they bought it. So we'll just have to wait and see. But I think all that's yet to come.
Do you think that the Fed is going to end balance sheet reduction or quantitative tightening? That 300 billion increase last week, that probably signals the end of balance sheet reduction?
I don't know. One of the things I don't do though is I never believe the Fed, and I never have really since Paul Volcker, because that will get you in trouble because they never do if you guide your investment process off the Fed, that you're wasting your time. And I think the problem now exists is that if they do or don't, I don't know, and we're set for it. So no matter what, but if let's just say they don't raise a quarter, but all of their data, which they are data dependent, says, hey, we're still not to that 2% or 2.5% level, then you see their confidence gets rattled again. People look at it and say, they're back to the same old stuff they've always done. Get a little bit of shakeup in the economy, the banking system, and here comes the Fed to the rescue. I really think this guy, Powell, I think now his goal is to not tie the stock market so much to that. We'll see, but I think that's what's happening.
So you think no more wealth effect? So the stated policy the last, since the Alan Greenspan era was the wealth effect, basically inflating asset prices, stocks, bonds, real estate. You think that that's done?
I do, for the time being. I'll tell you, it's been one of the worst experiments that any country's ever done. And I think it's caught up with them now. And so there's going to between a rock and a hard place. You can't really get too loose here because you'll be right back at 8 or 9% inflation.
But if asset prices crash, Ted, then won't government tax receipts, especially in a recession, because then the consumer's not going out shopping, going out eating, or to bars or restaurants, all those tax revenues, that would collapse then too.
Well, it would, but so would inflation. So if you're not buying anything, it's not going to go up. So I
But
think it all fits
DC wants to spend more though. So I see like someone's going to have to buy those treasuries and the municipal bonds because I don't see governments wanting to cut back on their spending.
Well, I don't either, really, Jason. I think one of the falsehoods the last 7 or 8 years is that the Fed, through their jaw boning, convinced everybody the rates weren't going up, transitory, all that sort of stuff. So all these bankers kept on buying bonds for nothing. See, it's almost like they're buying somebody needs to buy the bonds, so we'll convince the banks to do it. Maybe it didn't go, but it looks like
they bought the bonds on leverage too. I mean, that was the risk parity trade that Ray Dalio and a lot of the hedge funds were copying. So they were leveraging up their bond trades.
Yeah. Yeah, I don't have any idea what they'll do Wednesday. I would say if they raise it a quarter, probably people won't like it, but I don't have a clue, really. I mean, I never try to guess what'll happen with them, but I will say this: if you just go by the numbers they're using, their numbers are not in place right now to say, okay, we're not doing any more. And I think if they said, hey, we're going to take a little pause because of things that are going on in the banking system, see, they're right back again being the big savior. And I think, maybe I'm wrong, I think they're trying to get away from that.
But I think they've trapped themselves now because they're the government, U.S. federal government's interest. They've allowed D.C. to get away with just insane amounts of spending because the Fed was subsidizing all of it. So the Fed's like the enabler, kind of the bartender that keeps serving the drunk drinks.
Yeah, well, that's true. You're right. I don't disagree with you on that. Again, I'd always tell investors, hey, you got to look out for yourself. That's what you have to do. You can't depend on the Fed or the government, anybody else. You've got to look out for yourself.
Yeah, I agree. And I think at this point, the rate hikes, a quarter point, another quarter point here, there, it doesn't really matter because I think all the pain from the rate hikes is finally starting to work its way through asset prices in the economy and the consumer.
Interesting you say that. I was being interviewed just today, earlier, and they asked me about that. And I said, well, I don't think it makes a lot of difference whether they raise a quarter or don't raise a quarter, because believe me, the rates are high already. So, we'll see.
Oh, yeah, especially real estate. I mean, at these interest rates, real estate doesn't make really any sense if you're going to take out a mortgage for a property.
Well, real estate was another bubble, though. See, you look at 23% of the properties that were bought by individuals trying to do Airbnb or residential rent, all that sort of thing. Well, that's going to go away. And they keep talking about no supply, but believe me, you keep on going here. Everybody has a low rate. I mean, right now, but there's a certain amount of mobility that has to happen. And when it does, you'll get supply. When you get supply, you'll get lower prices, more than you have now.
Yeah. Plus, can the consumer, renter, person going on vacation, do they have discretionary income? Do they have the income to pay a higher rent or to go away on vacation and pay a higher price to someone trying to rent out like something? So I just don't. That math doesn't work either.
Yeah, that's true. Yeah, there's some of those Airbnbs are empty right now.
Yeah, that's the Fed's boom, the artificial boom with the low interest rates for 15 years, zero interest rate policy, quantitative easing. The rate hikes are causing the bust now.
Mm-hmm. That's what happens.
So as we wrap up here, Ted, one more question. I ask all my guests this. So we've discussed a lot of things that are kind of sobering. Is there anything you're optimistic or bullish on for the next 5 to 7 years?
Well, I think if you find things that are paying, say, 6 to 9%, that's going to be well in excess of what the inflation rate is, and so you'll be okay. When you find those kind of things. Then, secondly, I think when you get into a situation to where, hold on just one second. You get into a situation where you're. I think you just have to pick and choose, catch the markets when they're lower, trying to catch things when they're not overpriced. I think you'll have to trade the next 5 to 10 years, though. I don't think you can buy an index and forget it.
The index is also bubbled because they were every time people put money into their retirement account with these index funds, what it just kept buying market cap weighted, so it would buy what, not the meme stocks, the FANG stocks, so Facebook, Amazon, Apple, Netflix, Google.
Yeah, and then so I think I think again I think it'll be harder the next 5 years or so, 5 to 7 years, and I think people will have to realize at times they'll have to own more things. At times, they won't own as much. And the problem is we have so many people in the industry, Jason, that have been around the last 10 or 12 years, and all they know is plug and play. Put it all in, don't worry about it, and you'll be fine. Well, that probably is not going to work the next 5 to 10 years. When I first got in the business, the first 8 or 10 years, it didn't work either. And so that was what happened, you see.
Well, especially if governments and central banks are going to keep changing the rules. I mean, look at all the rules changes for the bank bailouts. Who's going to get a bailout? The rules changes for the FDIC. I mean, the FDIC doesn't even have those funds. So they have to go to Congress, and then Congress has to go and beg the Fed to print it.
So anyway, that'd be my answer to you. So just let you, hopefully that'll work for everybody,
Yeah, I think there's some interesting stocks for some of the low-cost oil and natural gas producers out there. I think there'll be more mergers and acquisitions if we go through a tiny little bear market here. And the pipeline stocks, like you said, as long as the pipeline stocks don't have a lot of variable rate debt, I think there's a couple of them with a lot of variable rate debt, and they have had to cut some dividends. But other than that, they look pretty good.
Yeah. Well, just keep your head on, that'd be my advice in here for sure. So it's been nice visiting with you for sure too, Jason.
Yeah, I appreciate it. And we'll have to have you back on in the next couple months for an update. I think things are going to be that crazy.
All right. I'll be happy to. Thanks.